corporate risk management, a primer. So this reading again is a small introduction to how risk management world works, and there is introduction to various terminologies in this. First point of discussion is advantages and disadvantages of hedging your risk exposure. This particular discussion they've divided into two parts. The first part discusses the theoretical reasons why we should not hedge. And then it says that even though these reasons are theoretical, they do not have any practical application. Then in the second part, it discusses what are the practical reasons why we should not hedge and the practical reasons why we should hedge. It is divided into three parts. First, the theoretical arguments for not hedging. So the first one is Franco Modigliani and Merton Miller. These people came up with series of research paper which discussed that why dividend decision is irrelevant, then why capital structure decisions are irrelevant, and in the same fashion why hedging is irrelevant for the valuation of the firm. Okay, so first argument here is, which is a theoretical argument, they assumed perfect capital market. This assumption is similar to CAPM assumptions. Value of a firm will remain constant despite attempts to hedge risk exposure. So here in that paper they discussed, irrespective of whether you hedge or you do not hedge, valuation of the firm will not have any impact on it. Then William Sharpe, he came up with similar theory that you can remove unsystematic risk without paying any cost, because he assumed that there are no transaction charges and it's a frictionless market, and therefore there is no benefit of hedging because unsystematic risk can be eliminated without any cost and systematic risk cannot be hedged. So again, both of these theories argue that there is no benefit of hedging. Most of those reasons to not to hedge make unrealistic assumption of perfect capital markets. Also, they ignore the existence of significant cost of financial distress and bankruptcy. You need to understand the difference of these two. First, you tell me what would be cost of financial distress. Yes? Cost of financial distress. If a company reaches to a stretch where now it is going to file for bankruptcy, then first thing would be it would have loss of sales. These points you can write down in your notes. Heading would be cost of financial distress. See, there can be a small theory question structured around it, so we need to know the technical difference. Cost of financial distress. First point, loss of sales, loss of profit. Both of these are opportunity losses, and most importantly, loss of reputation. Okay, all these losses are classified under cost of financial distress, and bankruptcy cost generally is associated with the legal cost of filing for bankruptcy. Now see, what is, to give you a big picture, what M&M theory says. First, they assume there are different versions of theories. There are 4 theories, but 2 of them, they assume that there is no concept of tax. Okay, so they said that you should think of a firm as a simple pie. It does not matter what portion of that pie is coming from equity and what portion of that pie is coming from debt. The valuation of that entire pie is going to remain constant. And they said that if there are 2 firms, one is 100% equity, the other one is 100% debt, the valuation is going to be same. It does not matter how you fund your capital. Now the difficulty with this is, when they said 100% debt, what they failed to consider the fact that when a company gets very heavily leveraged, there is a possibility of default because the interest cost is high, and if there is a possibility of default, then the cost of financial distress and bankruptcy comes into picture. Should we go ahead? Practical perspective, valid reasons not to hedge. First one, firm would be distracted from focusing on the core business. So let us say Narendra is helping someone manage forex risk, and he gets the entrepreneur or promoter involved in the forex management, and he gets so involved that he starts doing forex trading and forgets what was his core business. Lack of skills and knowledge. This is true with a lot of companies, especially in forex sphere, who do large amount of transaction, but they do not understand how to manage or hedge that risk. Transactions and compliance cost. Now, reasons why a firm should hedge its risk exposure. Lowering the cost of capital. Can you tell me how is that possible? A coffee bean manufacturing company trying to hedge the cost of beans, that is definitely a valid reason for hedging, but it will not reduce the cost of capital. Okay, here in this context, how they are asking you to think is, let us say, not about the amount. Let us say you have estimated that next year your capex requirement is going to be of 200 million. Capex means you want to invest 200 million into business. Out of this, 80 will come from retained earnings. That means your internal profits. 120 will come through external debt. But the possibility is that next year interest rate will increase. So when I go into market to borrow this 120 million, the cost could be higher. So I can enter into a derivative called, let's say, hypothetical FRA. And this forward rate agreement. And this forward rate agreement will lock in the rate at which I will be able to borrow 1 year from now. So reducing your cost of capital. Reducing volatility of reported earnings. So now I think coffee beans example is perfect. If you're a coffee manufacturing company, if the cost of input keeps on changing, then maybe you can buy a series of forward contracts so that the price at which you're buying your input is not going to change. It will reduce volatility of reported earnings. Make sense? Operational improvements. Potential cost saving over traditional insurance products. Okay, so next point of discussion. Decision on whether to hedge a particular risk, role of BOD, and the process of mapping risk. In hedging specific risk factors, it is necessary to consider the role of BOD as well as the process of mapping. Board should set a firm's risk appetite using one or more following tools. Qualitative statement of risk, whether it should be hedged or unhedged. So one example could be, let us say a firm makes a statement that forex risk should not be hedged. Okay, so it's a qualitative statement. Now what kind of firms can afford to do this? Let us say you are an organization like Unilever. You have businesses all over the world. Let's say Unilever, the parent company in Europe, has a subsidiary in India which is called Hindustan Unilever. Now the European company has an exposure to depreciation of rupee, isn't it? Because if that happens, then valuation of the company will decrease. But then Hindustan Unilever has assets and liabilities both. So if the valuation of the currency increases, asset will increase, liability will increase. If the currency decreases, assets will decrease, liability will decrease, the risk is offsetting each other. So you can come up with qualitative statements saying that maybe forex risk is to be remain unhedged, but credit risk is to be hedged, or vice versa. Then you can come up with a number like VAR. A daily VAR should not exceed XYZ amount. Or you can come up with stress testing scenarios. Are we fine here? BOD should consider conflict of interest between shareholders and bondholders. Tell me, what is this? Correct. See, bondholders, you can write down this point. Heading in the notes would be conflict of interest between shareholders and bondholders. Conflict of interest between shareholders and bondholders. And then right below that, you would say bondholders make an arrow and say no upside potential. No upside, side with a D, no upside potential. Make sense? For example, let us say there is a company. These are the shareholders of the company. These are the bondholders. Bondholders are promised a coupon of 12% per annum. But shareholders do not have a fixed return. So what shareholders would think is that if the risk increases, if the risk increases, then our potential returns will increase. But what bondholders will think is, even if the risk increases, our returns are going to remain 12%. And therefore, these bondholders would want all risks to be hedged. Whereas shareholders would want exposure to certain risks so that their upside potential of returns will increase. So as a board of director, your job is to ensure that you are working in the best interest of both the stakeholders. This point is important. Maybe you can write down, because I saw a theory question on this. BOD has to work in the interest. BOD is board of directors, has to work in the best interest of both the stakeholders. Now technically, board of directors are representative of equity shareholders. So you would expect them to work towards equity, but the sentence says that they have to work in best interest of both equity as well as bondholders. Next, clarification on whether we are trying to hedge the accounting risk or accounting profit or economic profit. Tell me, what is this? Whether we are trying to hedge accounting profit or economic profit. What is the difference between the two? Let's do an example again. Let us say, Himanshu, who is this? This is Himanshu. And Himanshu sets up a business. So he's got a job. Let's say he's making 2.5 million rupees per annum. And he quits his job. He sets up a business. First year he makes sales of 5 million. Cost involved is 2 million. Accounting profit is how much? 3 million. But how he would think is, even though from an accounting perspective he has earned 3, that 2.5 million is an economic cost. It's an opportunity cost. So he will say minus 2.5, and his economic profit now is 0.5 million. So from a risk management perspective, board of directors will have to clearly state that when we are trying to hedge risk or trying to hedge profit, which profits are they targeting, accounting or economic, and recommended is economic profits. Are we fine here? Clarification on whether we are hedging short-term or long-term accounting profits. Again, this can be tricky. See why? Let us say you got into an agreement with a client, and by the end of the year, this is time 0, this is time 12, you are expecting to receive 10 million from your clients, an Indian company receiving 10 million. Now what this company did is, it entered into a short forward contract. Short forward contract where after 12 months it will be entitled to sell those 10 million US dollars and receive Indian rupees. Now the difficulty is, this is the closing of first quarter and today they have to prepare their books of account. Now most of the accounting standards, including IFRS as well as Indian accounting standards, they will require you to calculate what are the mark-to-market profits or losses on every financial statement preparation date. So this 10 million is coming to you in 12 months, so it is not recorded. But if you made losses here on this, so technically when you are making losses on forward, you are actually making profits here, isn't it? Because they are working in opposite direction. But the profits are not getting recorded, but derivatives are requiring you to record those losses. And therefore, you will have to also decide a strategy that whether you're trying to hedge short-term or long-term accounting profits. Are you clear with this concept? Other points now. Time horizon, possibility of implementing definitive and quantitative risk limits.